Hey Ross World, my money makes money. Now, I want to tell you the huge difference between a mutual fund and an index fund. So, mutual funds are actively managed accounts. And that simply means that when you call into your bank and you say, hey, I want a mutual fund, they say, okay, what type of mutual fund do you want? And they have these particular set portfolios of mutual funds. Those mutual funds are actually managed either by the bank or an investment company that they have working on their behalf. Now, whether they outsource it or insource it, the fees are there. And this is one thing they never tell you, that you're paying anywhere from 1% to 5% on the money you have in your account to get all these transactions done, because mutual fund stocks and bonds, they actually sell them in less than a year. Now, you still have that particular mutual fund name, actively Cornerstone, aggressive, whatever. You don't know what's going on. The only thing you know is every month you may be putting in $50 or maybe $100, and they're actively managing your account. You may not even know they're actively managing your account, and you may not even know the particular fees that are associated with your account. But not only are you paying transaction fees for them to do whatever they're going to do with replacing stocks and bonds to see if they can get the best returns, because don't forget, they're not only making money for you, they're making money for the bank, they're making money for themselves, and they're making money for those companies that actually have stocks. The way they make their money is all these fees, and then you have to pay taxes every single time there's a transaction. Now, because of all these transactions, you will not benefit from the lower capital gains tax rate, okay? Because of all these transactions. So, regardless of how long you hold this particular fund, you will still be taxed at the higher or ordinary income tax rate. And you're probably saying to yourself, why should I care? Well, you should care because your profits will be slashed 30% or more unless you're holding your money inside of a tax deferred account like a 401k or an IRA, your individual retirement account. The way index funds differ is because index funds are not actively managed. They're passive. They're basically on autopilot. Now, with index funds, the big difference is that with mutual funds, they're trading majority of their stocks and bonds in less than a year. So fees, right? Where those index funds, they simply buy stock and hold them because an index fund is tracking an index, something like the S&P 500 index. And inside these index funds, they have your regular company, so you be a fractional owner, but either way, you're still gonna be making money. But Apple, Microsoft, ExxonMobil, Johnson and Johnson, and so on. Some of the ones I just named are like the five largest, with Microsoft as well, the five largest stocks in the stock market. Now, index funds, they are almost entirely on autopilot, okay? They do very, very, very few trades. So their transaction fees and their taxes are incredibly low. We're talking about incredibly low compared to a mutual fund. And because the index funds are on autopilot, they don't incur the same fees as a mutual fund. They don't have some big Ivy League guy from Yale or Stanford or Harvard managing the portfolio, so you kill fees there. Any sort of human fees. You don't have to pay any percentage to these actively fund management account holders or investment companies. And this is another thing, because it's a tracking service, because it's tracking stocks on an index, it consistently makes money. So when you have your mutual fund, what are you actually paying for? You have your transaction fees, and then you also have your taxes. But this is the thing. You're also paying for that toxic brew of human nature, okay? Because since they're actively managed, that means someone is going in there and they're actually pulling out stocks, replacing stocks, trying to predict the stock market. And everybody knows you cannot predict the stock market. So let me put this in perspective so you understand what I'm talking about. These mutual funds that are actively managed, they're about 3%. 3% is 60 times greater the amount of an index fund, which only charges you 0.05%. Now, who really wants to pay 3% when you only have to pay 0.05? So in layman terms, what does that mean? Your friend goes in and buy a venti latte from Starbucks at $4.15. When you go in and you buy your latte for $249, that is the difference in money. You need to understand your percentages. You need to understand your decimal points when it comes to this money, because all of this counts. All of this counts. So if you ask me where my money is and where my money is going to go, is going into index funds. Okay, now, if you like mutual funds, and of course, I'm a lover of ETFs, check out Vanguard, check out Schwab, check out their index funds, because they have ETFs and they also have mutual funds within them, and you will not pay those fees because they are index funds. Okay, the mutual funds and the ETFs are actually inside the index funds, and that's how you save on fees. That's how you save on taxes, because no one wants to pay that when you really don't have to pay it. This is Ross World. Choose index funds. Leave mutual funds alone. I'm out.